of Musk and Ramaswamy align with the political advancements in crypto regulation and adoption? Well, we don't know. We don't know. I mean, they can't head up the SEC. I actually think there will still be regulation on it. It just might be a little bit more friendly. They might not be as aggressive on the what Gensler was trying to do. If you watch his MIT YouTube on cryptocurrency, it's fascinating. So just go to YouTube and it's like Gary Gensler MIT lecture. He did a fantastic job defining what cryptocurrencies are. So if you don't know about it, this stuff, watch Gensler's lecture. So he's a deep knowledge, and I have some knowledge of the industry. And the problem is scam artists are treating it like it's a security or an equity round to raise funds for a business, but then they call it a token or a cryptocurrency, so they avoid some of the regulations of the securities industry and they go into the cryptocurrency industry. That's what happened with XRP. And a lot of these coins have very dubious things going on with them. So, but that being said, a lot of people think Trump's going to ease up on that. Now, this is kind of interesting. Warren Buffett is loading up on cash, should you? Berkshire's cash allocation has moved to a higher level not seen since before the great financial crisis of 2008. What does he know that we don't? Buffett's cash allocation on his Berkshire Hathaway stock has been actively reducing its holdings in major companies, notably Bank of America and Apple, while simultaneously increasing its cash reserves. This strategic shift has raised questions about the motivations behind these decisions and their implications for the broader market. Key developments. But first, I want to hear from you. Give me a call now, 800-321-0710. If you have questions on stocks, bonds, annuities, mutual funds, whatever question you have, no question is a dumb one, except the one that you do not ask. So pick up the phone now, give us a call. I'd really like to hear from you. Berkshire has sold approximately 25% of its recent stake in Apple. Despite this reduction, 25% of its overall holdings, Apple is still one of Berkshire's largest investments. The firm has also been selling shares of Bank of America, bringing its ownership below the 10% threshold. This change means Berkshire is no longer required to promptly disclose further sales of the bank's stock. Berkshire's cash holdings have grown for 9 consecutive quarters, reaching a record level. This accumulation suggests a cautious approach, possibly in anticipation of future investment opportunities or market downturns. Well, what are the potential reasons for this? Does it signal a market crash? The total value of the stock market has risen to approximately double the U.S. GDP, a ratio Buffett has previously described as playing with fire. This may indicate concerns about overvaluation and potential market corrections. Profit taking. The significant appreciation in stocks like Apple may have prompted Berkshire to realize gains, especially if future growth prospects appear limited compared to current valuations. And then preparation for opportunities. By increasing cash reserves, Berkshire positions itself to capitalize on future opportunities, particularly during market downturns when asset prices may be more attractive. And this is the thing I'm worried about if you're bullish just because Trump won the presidency. There are people who don't necessarily like the president or who voted for the other person, a la Buffett. He tries to keep that quiet, but he's generally left of center. And you don't, if Buffett's against you, if Soros is against you, if Jerome Powell makes subtle things that might be bad for the stock market, what's going to happen to the market? It's largely been kind of proven, I think, that presidents don't really control the market. They might increase sentiment, but you might have a little Trump bump. But long term, the stock market is neither red nor blue, it's green. People want to make money on both sides. Market sentiment. Berkshire's action could signal caution to other investors, particularly influencing market sentiment and leading to increased volatility. Investment strategy. Investors might reconsider assessing their portfolios, ensuring diversification, and preparing for market corrections. Monitoring cash holdings. Berkshire's growing cash reserves suggest a wait-and-see approach, indicating that the firm is poised to make significant investments when favorable conditions rise. Russia's revised nuclear doctrine raises global market concerns. Recent developments in Russia's nuclear policy have had significant implications for global financial markets and investor sentiment. On November 19th, Vladimir Putin signed a decree updating Russia's nuclear doctrine, lowering the threshold for nuclear weapon use. This revision allows for nuclear response to conventional attacks from non-nuclear states supported by nuclear-armed nations such as the U.S. We'll talk more about geopolitical tensions and their implications on the market when we return. This is Josh Jelinski, the financial quarterback. Give us a call now during the break, 800-321-0710. Call me right now, 800-321-0710. We'll be back after these messages.
Josh and his team at the Jelinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jelinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jelinski.org. That's JALINSKI.org. Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check.
Hear from you, 800-321-0710. If you want to talk all matters financial, give us a call right now. The financial markets have responded to heightened geopolitical tensions with increased volatility. Safe haven assets like treasuries or gold have surged, with prices nearing their largest weekly gain in nearly 8 months. This trend reflects investor concerns over potential nuclear or war escalation and the broader impact of Russia's policy shift. There have been talks that Trump has been leading some type of peace summit at Mar-a-Lago. But the only thing I found when I researched it was Moms for America is having an event this weekend at Mar-a-Lago. In contrast, European stock markets have experienced declines. The pan-European stocks 600 index dropped to a 3-month low, influenced by geopolitical uncertainty stemming from Russia's updated nuclear stance. Investors are moving towards more conservative assets, causing fluctuations in various sectors, including automotive and banking. So I'd really love to hear from you. Give us a call, 800-321-0710. We're live, taking your calls, unscripted, uncensored, shockingly raw. Come on, give us a call, 800-321-0710. So investors moving towards more conservative assets, causing fluctuations in various sectors, including automotive and banking. How does Russia's nuclear doctrine change impact for global markets? Am I the only one? I think a lot of this is I don't believe we will have nuclear war. Am I? Why? Well, one, Trump has said in the past he's against it. Now, there has been, conspiracy theories. Oh, before Trump's in, Biden's going to get us to World War III. But I don't think anybody really wants to go to nuclear war. So I think whatever immediate financial market responses will go back to being more positive for the markets long term. You got to think long term. You can't let these day-to-day news things distract you from your broader financial goals. So energy could also be an issue. This could lead to disruptions in global oil and gas markets, with Russia being a key player in energy exports. How might energy prices surge? And what would this mean for inflation and consumer spending? The role of safe haven assets. During times of geopolitical uncertainty, assets like gold and U.S. Treasury bonds often see increased demand. Could we expect a similar pattern now? Is cryptocurrency, particularly Bitcoin, becoming a new safe haven asset in the face of traditional market volatility? Next, we're going to go to the phone lines, and we have George. George, what's your question?
Yeah, hi, Josh. Josh, I'm 61 years old. I have about $2.5 million in 401k funds. About 400,000 of that is in a money market fund, and I'm planning on retiring next year this time. My plan is to take about 150,000 out of the money market each year, and then replace it with the money that's in the market, and deposit that into the money market fund, so that I constantly have a buffer there, but I have the rest of my money in the market. I mean, is there something wrong with that strategy?
No. I talk about it in my book, The Retirement Reality Check. It's called the Volatility Buffer Strategy. You may want to have 1 to 3 years and in something like treasuries instead of. So what we do with a lot of clients is we'll have people want the volatility buffer strategy. 1 year in a money market, 1 year of expenses in a money market, year two's expenses in a 1-year treasury, year three's expenses in a 2-year treasury, year four's expenses, almost like a ladder, And the reason we do maybe 3 years is because if we look at the global financial crisis in 2008, it took about 3 years for markets to break even from that. So that's kind of where I get that 3-year volatility buffer concept. But then you want to look at, is that the most efficient use of your dollar, right? So could you do other things like bonds, corporate bonds, treasury bonds, fixed annuities to build you your income that you need, right? And then you risk the rest in the stock market. So for example, let's say you need, I don't know, what do you need to live, do you know?
About 150 plus, whatever I get from Social Security.
So
it's
it's
about
150.
75.
So you need 150 from Social Security, including?
No, about 150,000 a year to come out of the 401ks.
Okay.
And then whatever I get from Social Security.
Yeah.
My wife had passed away, so I was going to take her Social Security when I get 62, and then when I hit 65, I'll switch it to mine. That was my plan.
Well, I think you're eligible for it at 60. So.
Right. I'm eligible for my wife's at 60. That's correct.
So, yeah, I think you'd benefit from coming in and doing a retirement reality check. 150 is a lot to take out of an equity portfolio. So there might be better strategies for you than that, but we could certainly, like I have calculators where you can model out the volatility buffer concept, or alongside of other concepts like income concepts. So if you had you have about 2.5?
About that, yeah.
And you need about 150. So we've a
That's
great.
why I maintain my lifestyle. That's what I want to do.
Yeah. And then, if you have like a 20-year retirement, hopefully longer, but you never know. And we go to historical rates. So we can actually model out this whole concept. And then I like the volatility buffer concept. I would just make sure it's an adequate amount for you. That you have the proper ratios. Like what you may want to do is do bonds instead. I'd have to look at the numbers and really run them. But we have a really powerful tool. So it's kind of interesting. When I'm running through, right now, I'm looking at our software. We have a calculation. So I'm putting in 2.5 million. I'm taking out 150 grand a year for 20 years. What I do is I always model a financial plan. And I recommend you do this from the year 2000. Now, why do I do that? The market's high right now, just like the 90s. So we're due for a correction. And then I model that out. And just let's say you put it all in the S&P. You're not doing that because you're adopting volatility buffer concept, which is better than just blindly keeping it in the S&P. If you went through another 2000 to 2016, which we won't, right? The future is always a little different than the past. But if you model out a crash and a recovery, you would run out of money in 17 years just on the S&P. If you change that to an 80% stock, 20% bond portfolio, you run out of money in 19 years. If you change that to a 70% stock, 30% bond portfolio, you still have 201 grand at least left to your name in year 20. Now, I didn't inflate that 150 every year. So I'm just telling you what our software does. So you can model out these different scenarios. So we'll do that for free with you if you call us at 888-988-JOSH. If you or any of our listeners want help building a retirement income plan. So we have this modeling software where you can model the volatility buffer concept as well. It's a different calculator than what I'm looking at right now. It's called the Retirement Pressures Calculator. So you can say, what if I have X number and I draw from that in a downturn? So what you're saying is really brilliant. It just might need to be tweaked. Does that make sense?
Yes, it does. Thank you.
And where'd you get that volatility buffer concept? I like it.
I listen to your show. I read a lot of the books, and
yeah,
it's just I've had my money in the same place for 30 years in the 401ks and those index funds, and since I worked at Red Lobster when I was 20 years old.
Awesome.
And it's
Yeah, so
Never changed.
I'm a big believer when you are growing your money, right? The rules are different than when you're living off of it, right? So you could have put all your money in funds from the 80s, right? And you could have millions of dollars right now, or the 90s. That doesn't exactly work when you're retired because the economics change. Like I just did when I said, oh, you'll run out of money in 16 years. I just said you put all your money in the S&P 500 in our modeling tool. So index funds work great when you're growing your wealth, but you need to have a strategy that I call sequence defense, similar to your volatility buffer concept, but I would do it a little differently. And you can actually see what is the optimal amount to generate a schedule of income utilizing. So if your desired income is 180 grand, let's say, and 30 grand of that is Social Security, you can see when will you have failure. And I did volatility buffer concept generating 500,000. That's why I said you might be too low on the volatility buffer. Does that make sense? And
Yep.
after 19 years, assuming a return of, but I mean, we'd have to run the numbers more, basically. But it's pretty cool that we have a calculator that does what you want to do. Yeah, you got to be careful because I'm looking here, taking 150 grand out of the S&P. In one strategy, you run out of money in 12 years. So yeah, we got to tweak this and give us a call for the retirement pressures calculations. 888-988-JOSH, and congratulations on a happy retirement, and would love to meet you at 888-988-JOSH, and I'm so sorry for the loss of your wife. So next up, we have Gina. Go ahead. On crypto. Let's take Gina's call after we return from the break. We'll be back after these messages with Gina and your calls at 800-321-0710. This is Josh Jelinski, the financial quarterback. Don't touch that dial.
Josh and his team at the Jelinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jelinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jelinski.org. That's JALINSKI.org. Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check.
This is Josh Jelinski, the financial quarterback. Gina dropped. If you have your question, Gina, feel free to call us at 800-321-0710 and give us a call, 800-321-0710. So this retirement pressures calculator is pretty cool. I'm going to show it on the screen for those of you watching, where basically what you can do is say, well, if my desired income is 150 grand or 180 grand, and I'm getting 30 grand from Social Security, and I have $2 million saved for retirement, you want to retire at age 67, and let's say you have a life horizon of age 90, you can run through, well, what if I have all my money in the S&P 500? And taking 150 grand a year out in the beginning of the century would have equated to having no money left in 12 years, even if you had 500,000 in non-market sources. So you got to be careful when you're doing this. You know, you don't want to do it alone, right? So what happens here is what Sequence Defense says is when the market goes down, you're not going to pull from the market. You're going to pull your money in a down year from your bucket of money. And what's kind of cool is if you had 500,000 in non-market sources, could be annuities, corporate bonds, treasuries, and 2 million, instead of your money lasting for 12 years, it lasts for, it runs out in 19 years. So it runs out 19 years with Sequence Defense. It runs out without Sequence Defense. If you had the whole 2.5 million in, it runs out in 16 years. So not 12, but there's a lot here. So give us a call, 800-321-0710. Next up, we have Gordon. Go ahead.
Yes, Josh. Good morning. First of all, thank you very much for having shows where your listeners can call in and ask their own questions. I have two fast questions about Bitcoin. My first question is, does any aspect at the present time, does any aspect of the blockchain usage require the use of a cryptocurrency like Bitcoin?
I'm not getting your question.
If you want to use the blockchain technology, does any part of it require the use of a cryptocurrency like Bitcoin, for instance?
No, it doesn't require it. No, it's just Bitcoin is a blockchain.
Oh.
Yeah.
Okay, so that was my first question. Second question is, if you live in a country where there is a totalitarian
I think the bigger
government,
question with that is, do other things benefit from, would other industries benefit from blockchain like what Ethereum's trying to do with art and smart contracts? And that I would say no, meaning money is a very clunky, meaning Bitcoin is a very clunky application. So you're basically using computing power to solve very complex mathematical algorithms. And what is the purpose of that other than in the use of money and a decentralized money? And I think other companies have tried to, like NFTs, that kind of flashed and burned, like linking art to cryptocurrency. I think it doesn't make sense too much, for other uses. The other thing, can totalitarian countries manipulate crypto? I guess they could develop their own cryptocurrencies. They've tried to manipulate, Bitcoin in a way is anti-totalitarian. There's a great article by Preston Pish called Bitcoin is Anti-Totalitarian. And what's interesting here is, there have been worries that, okay, China was too involved in Bitcoin. But anytime totalitarian countries have banned Bitcoin, Bitcoin survived that, right? That was a big risk to Bitcoin. Oh, China banned it. And it's actually imperative that the U.S. takes a leading role in the innovation of Bitcoin, kind of like the internet. So I think Bitcoin in a lot of ways is anti-totalitarian. Hope that helps you.
Yeah. So even a very strong government cannot prevent access of its citizens to Bitcoin.
No, it they've tried, but they've failed. I mean, any country where they've tried to ban Bitcoin. Now, that's different than regulation of cryptocurrency markets, which can be done. But the act of decentralized peer-to-peer money is the future. It's just, which applications win. So they've not blocked it. They've not banned it. We have some comment they can block the internet, which blocks access. They haven't, though. Those countries that have blocked it, the people go on VPNs and they figure ways around it. I mean, it's not, anytime a country has attempted to ban Bitcoin, it has inevitably helped Bitcoin get bigger adoption in the black markets because people want freedom. So it's sort of like when the U.S. government tried to ban alcohol and prohibition. What happened? There were speakeasies, all that stuff. So next up, good question, Gordon. Next up, we have David. Go ahead.
Hi, Josh.
Hi.
Wonder if can you hear me? Okay.
Yes.
Okay, great. Long-time listener. Took your advice about 2 years ago. Invested in an indexed annuity fund, and the first year I was in, it was based on the stock market. I gained 12%, which was the cap that year, and the following year, which my maturity date is coming up in mid-December, I chose the stable 5.25% interest. Do you suggest I switch back to the base of the stock market? I know you can't figure out when the stock market's going to take a dive, but I see Warren Buffett selling a lot of stocks and holding cash, and I want to know, is this a good time to switch in mid-December to the stock market basis?
Sure. 5.25%, if that's your fixed rate, and just to be clear, we're not giving any advice over the radio waves, but what he's talking about is there's a particular type of annuity called a fixed indexed annuity, and you commit for a certain number of years, 4 years, 7, 10, depending on the contract, and you have a choice generally each year to go between the fixed account and the indexed. The indexed, he said, made about 12%, which is a great return. The fixed made about 5.25%, which is also a great return. So nobody knows what the market's going to do in any given year. So generally with the fixed indexed programs, I like to stick with the S&P every year because there might be 7 years where it does well, 2 or 3 years where it doesn't. And if you take the average will be positive. That being said, we've had 2 good years in the index in a row. I read some article, the last 2 years, the indexes have gained more in consecutive years than any years since like the 90s or something, meaning like 2 good years in a row. So we're kind of due for a correction. I would agree with that. You could put it all in the fixed again. You could also split it. You could do 50% in the fixed, 50% in the indexed. Or if you believe next year is going to be a big rally year, you could put another, you could put it back in the index. It's very hard to predict what the market's going to do year by year. Now, decade by decade, it's easier, right? Like 7 out of 10 years probably going to do well. So my answer is sort of a cop-out, but it's really whatever you feel comfortable with. If you put your money in the index, you got to figure out, are you a bird in the hand or 2 in the bush person? When you choose to allocate from fixed to indexed, and if the index goes down, you don't make anything that year. So it's not really there's no risk to your principal, but there's a risk in your decision. But, you know, I mean, personally, I would just keep it in the index every year. And if you get a 0 one year, well, that means you didn't lose money. So that's what I would do. But it's not my money. And you may just like to make 5 1/4 fixed interest, you know. So there's, or you could you split it, do half and half if you don't know, if you're kind of clueless. So, yeah, that's the other thing. It doesn't have to be an all or nothing. You could allocate 70% to the index, 30% to the fixed. So hope that helps you, David. Any other questions on that?
No, I think I'm pretty much set. Just waiting for the market to take a correction.
Yeah. Yeah. See, the thing is, though, I think we are all waiting on that. And we're like, it has to go down. But there have been periods of history, particularly the 80s and the 90s. Like if I go back to the S&P, I'll watch it go down this year, right? Because everybody's kind of bullish on, you know, Trump in the White House or whatever. And by the way, just because the Republicans in the White House does not mean the market's not going to go down. So it's interesting. The 80s had a period from 1982 to 1989 where the S&P did not experience a negative year. The 90s had 1990 was bad. Every other year was good. So could we have this? You know, people are big believers in the market right now. We need a, you know, in some sense, we need another crisis to get people to be humble about their expectation of the market. I mean, the 2022 crash was bad. The COVID 2020 crash was bad. So give us a call. David would love to talk to you. 800-321-0710 if you have a financial question for me. 888-988-JOSH. Give us a call. 888-988-JOSH for a free review. 888-988-JOSH. 888-988-JOSH. We'll be back all next hour with your calls. 888-988-JOSH.
WOR and WAXQ HD2 New York,
an iHeart radio station.
Listen on the free iHeart Radio app for all your music, sports, talk, and podcasts.
Free. Never sounded so good.
New York.